This video is a little less technical in its nature as we are discussing trading psychology and risk management. The thing about trading psychology, and this is truly one of the more ironic things about trading, is that people tend to gloss over it. And at the end of the day, it's what makes the difference between those who are profitable in the market longer term and those who aren't. And in fact, at the end of the day, a market can only go one of three directions. It can either go up, it can go sideways, but it can't do that forever, or it can go down. If it goes sideways, you're not going to lose any money, or at least nothing to worry about. So at the end of the day, you really have a 50% chance of getting the direction right. However, the washout rate of traders is much higher than that. And this is because of psychology. Let's think of it this way. If you have a money manager who's handling your retirement or investment account, who purchases stock in, say, General Electric, and it gets stopped out. Let's say it takes a small loss or even a sizable loss. Are you going to fire that money manager on the spot, or are you more worried that your equity curve just rises slowly over time? I mean, you don't expect a professional to get every trade right every time. You understand that your equity curve will ebb and flow over the next 20, 30, 40, 50 years. So the question I pose to you is, why do you expect something better out of yourself? And that's where trading psychology becomes very crucial, because a lot of times what you'll see is people will refuse to acknowledge that a trend has changed or something serious has changed in the market that they're involved in. And they'll continue to do the same thing, compounding losses. So for example, and I'm going to reference the Bitcoin dollar weekly chart for a lot of this, because I think there's a lot of lessons on this chart. When this candle formed on this weekly candle, somebody who understands technical analysis would understand just how bearish that was. However, there were people saying this is only a momentary blip. We're going to go to the moon. I remember hearing that about Bitcoin all the time. And then we continued to fall, and people just continued to buy and buy. And those people were wiped out. Those people aren't standing anymore, or most of them, I would say. They typically will do things like double down on a position or even take out larger positions, thinking that if we can just rally $1,000 and I've tripled my position, then I can wipe out all the losses from up here and then I'll get out. And inevitably, they stay in because they're starting to make a profit again, and then they lose. And this is fear and greed in its finest. Another thing that this chart demonstrates is the absolute mania in a bubble. And let's make no mistake about it. Bitcoin was in a bubble in 2017. That is not a healthy looking chart. That is a chart that shows no signs of slowing down and has gone parabolic. Parabolic markets always lead to tears. There was no way this wasn't going to happen. Trading psychology was so skewed in one direction that it was ripe for the short sellers. You started hearing about cryptocurrencies everywhere. Around this time, you started to see a lot of people popping up on YouTube who were gurus in other industries suddenly becoming cryptocurrency experts and selling courses on it. When you see it everywhere, it's too late. The smart money gets in much earlier. The technical analysis signals on this chart were everywhere to start buying. That was a good candle. Breaking that candle was a good candle. That was a good candle. That's when the smart money gets involved. There's no need to add to a losing position. When you set your stop losses, you need to decide at what level have you been proving wrong, and you do not move your stop loss unless, of course, you're moving it in the favor of your position. So, for example, if you got in here and you had a stop loss underneath this candle, knowing that, we may or may not be ready to take off, and we've made another swing high, we pulled back, we've broken above that candle, moving your stop loss to here to lock in profit, totally different story, totally doable, because longer term, you're going to protect your account. Unfortunately, what happens is people who get in up here will put in a stop loss, assuming they put in a stop loss at all. But if they do, say they'll put it at the bottom of that candlestick, and then as it gets close to that, they can't stand the idea of taking the loss, and they'll move their stop loss down here. And then it'll bounce. And then it'll fall. And then they continue to move their stop loss lower because they do not want to take that loss. You have to think of it this way. When you're entering a trade, you're paying for information. So, for example, some of the best traders of all time, and this is long before cryptocurrency markets, would say risk 1% of their account. And the reason for that is because losing a trade or 2 or 3 isn't going to cause irreparable damage. Also, they look at that 1% as paying for information. So if you get into the market here, regardless of which direction, long or short, whether you're buying or selling, doesn't really matter. What matters is, what information does that 1% tell you? So let's just say, for whatever reason, you started selling Bitcoin at this level. You thought it was too expensive. You get your stop loss hit. You've lost 1% of your account. Well, you know something now, and it only cost you 1% of your account. You know that the uptrend is continuing. So what do you do with that information? You look for an opportunity to buy it. In this particular case, now, granted, this is an extreme case, but if you risked about 1% here, just on that one position alone, you turn around and make 7 or 8% back pretty quickly. Well, at the end of all of that, you're up 7, 8%. That's really, or 6%. And that's really not something to shake your head at. I mean, that is the essence of trading, making more than you're losing. Understand that you need to have trading strategies involved in your trading. And the most important, of course, is knowing when you need to get out. Taking profits, one thing, but knowing when you're wrong and admitting it will save you a ton of heartache. Not risking your entire account on a trade will save you a lot of heartache. Quite often, you'll get a situation where you're in this cluster and that's when you get out. And you'll notice that these areas do act as important levels time and time again. And that's where the support and resistance comes in. You set your stop loss underneath support if you're going long, or above resistance if you're going short. You let the market prove you wrong. Once you have your stop loss in place, there's not much left to do other than manage your trade. And managing your trade means one thing and one thing only. Moving your stop losses higher as the move goes in your favor to the upside, or lower to the downside. There does come a point, obviously, you want it to be a free trade, so you move to break even. And then eventually you gain more and more and you move your stop losses higher. There are hundreds of ways to do this. But probably the simplest is just finding support and resistance levels. I cannot stress enough how giving yourself a break and giving yourself the freedom to look at each trade as one in a marathon of trades that you're going to make, and looking at the big picture, understanding that it's okay to take the occasional loss because you are trying to find out where the market's going to go for the longer term, the bigger money. The big money does not scalp the market every 5 minutes. The big money finds important areas, asks a question, is willing to pay the admission fee, and then does what the market tells them. It doesn't matter what you think the market's going to do. It's going to do what it wants to do. It's that simple. As a personal note, this candlestick here, I remember being in a restaurant and listening to a man who was probably in his early 70s talk to his children about this great new Bitcoin thing and how he was going to buy a ton of it. And I was overhearing this at the table. And I knew at that point we were close. But it did take another month. Now, I didn't jump into the market and short Bitcoin with 50% of my account at risk because I would have lost half my account. I would have had it taken out this following week. But I knew we were close. And at that point in time, the one trade I knew you couldn't take is to start buying more. There were a lot of commercials out there telling you to do so. But when you see a chart like this, a little common sense goes a long way. Make sure that the impulsive trades that you take, number one, don't exist because you need to have ins and outs. You need to know exactly what you're looking at. But number two, make sure that they make sense. That was a complete breakdown of common sense at this point if you were buying at 18,000. There's no way that could keep up. And now, another aspect of trading psychology that we see all over the internet is talks about, well, happy days are going to be here again because look, we're holding 6,000. And that could very well be true. But these people up here at this point are now praying for that to happen. And maybe they'll be saved. We don't know. But if you're levered to this, you have to multiply that loss by 3 or 10 or 20, whatever your broker allows. In the Forex world, it can be as high as 1,000. So you can imagine how dangerous it is over there. Set your stop loss, honor your stop loss, understand that you're trying to find out the bigger move. You have the ability to win 1 out of 3 trades, for example, and still make a ton of money. If that one trade nets 10 units and the other 2 lose 2, you're still up 6 units, maybe think of $100. That's what proper money management will do. I want you to look at the charts. I want you to look for the psychology in each chart that you see and realize that this is a mania. Manias are not good. They get slapped back down. Something like this is much more sustainable. That's another thing about psychology you need to understand when the market is acting rationally. There is a certain amount of rationality to this 6,000 level offering support right now. That doesn't mean that it will hold. And what else could you take from this chart? You could say, well, if we break down below that level, and it's actually somewhere around 5,900, but if we break down below that level, then we know we have further to go. You risk a tiny bit if you're willing to buy, 1% or 2%, and as it shows proclivity to go higher, maybe breaking the next high to continue the move higher, then you add to that position. You don't go all in down here in case we flush out. If you do that, your account will last much longer. You'll be much happier. And most importantly, at the end of the day, you will become a profitable trader.